Welcome back, my friends. I know that maybe you expected another video about big tech week earnings and maybe layoffs. Don't worry. It seems that there are many more of those to come, given the weakness of earnings season. But what about the rest of the economy? And what about cars? And what about Carvana? Carvana has been weakening financially for a few quarters now. And they have never been profitable. Sounds like the situation with a lot of tech unicorns, doesn't it? Well, Carvana had yet another bad quarter. And it is questionable how many of these disastrous quarters they still have in them. Carvana could run out of cash if the next few quarters are like Q3. So, what is the real future of Carvana? What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shares of Carvana posted their worst ever today. Carvana missed Wall Street's top and bottom line estimates for the Q3. The future outlook for used car demand is softening significantly. Car pricing and profits soared during the coronavirus pandemic. But that seems to be coming to an abrupt end. Shares in Carvana cratered 39% to end the trading day at $8.76 a share. That is down, but slightly higher than its worst ever closing share price of $8.72. Shares of Carvana have cratered 96% so far this year. That is after hitting all-time intraday high of $376.83 per share just over 1 year ago. Investment bank Morgan Stanley pulled its rating and price target on Carvana and will not even give another target. That is a bad sign when that happens. Morgan Stanley analyst Adam Jonas said that the used car market is deteriorating. And that unprofitable companies face a volatile funding environment. While the company is continuing to pursue cost-cutting actions, we believe a deterioration in the used car market combined with a volatile interest rate funding environment, Jones wrote in a note to investors. Bonds trading at 20% yield add material risk to the outlook, contributing to a wide range of outcomes, Jones continued in the note. During the pandemic, pricing and profits of used vehicles have skyrocketed. That is because car buyers who could not find or afford to purchase a new vehicle decide to buy a used car or truck. Inventories of new vehicles were pretty sparse during the coronavirus pandemic. That was largely because of supply chain issues, not least of which was a global shortage of semiconductor chips. Nevertheless, rising interest rates, inflation and recessionary fears have basically cornered consumers into paying these record prices. Large franchised new and used vehicle dealers such as Lithia Motors and AutoNation warned of softening in the used vehicle market when recently reporting their third quarter results, Jones added. Next year will be a difficult one for Carvana, said Carvana CEO and co-founder Ernie Garcia. A normalization of the used vehicle industry from its inflated levels and increasing interest rates, among other factors, will hurt Carvana, Garcia continued. Cars are an expensive, discretionary, often financed purchase that inflated much more than other goods in the economy over the last couple years, Garcia also said. And it is clearly having an impact on people's purchasing decisions, he added. The end of Q3 is basically the most unaffordable point ever for customers who finance a vehicle purchase, said Garcia. Basically, all financial numbers of the Carvana's operations were worse in Q3 as compared to Q3 of last year. Not least of which is a 31% decrease in gross profits to $359 million. Cars sold plummeted 8% compared with Q3 of last year to 102,570 vehicles. Gross profit per car sold, which is a highly watched metric by investors, sank by more than $1,100 to $3,500. Carvana report a loss of $2.67 per share. Total revenue was $3.39 billion, which fell short of expectations. If you were watching the various public company earnings being reported, you already know what is going on. It is fair to say that Q3 earnings were weak or weakening in most companies, aside from oil companies. And, you know the financial and economic narrative of the times. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. And cars are something of a discretionary item. Corporate marketers are cutting their ad budgets, especially online. And ad revenue is the lifeblood of many big tech companies. You probably all remember from the round of Q2 earnings announcements a few months ago. Meta has posted shrinking revenue for 2 quarters and maybe a third quarter as well. Meta has begun quietly pushing out a significant number of employees. The company has restructured departments and given employees 30 days to find a new job within the company. This enables the company to cut a lot of positions without having to issue pink slips en masse. Analysts expect these reductions to be a precursor to deeper cuts. Meta is trying to cut costs by at least 15% by the end of the year. Meta has about 83,000 employees, which is 32% higher than at this time last year. Google has 174,000 employees, which is 20% higher than this time last year. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. Shares in Meta platforms are down by over 50% so far this year. And the market capitalization of Meta has fallen by over $685 billion since its all-time peak in September 2021. The market capitalization of Google is down 27% over the past 122 months. Alphabet chief executive Sundar Pichai said, Google would slow hiring for the rest of the year and employees should be more entrepreneurial. Speaking at the Vox Code conference, Mr. Pichai said that Google needs to be 20% more productive. But not all big tech companies are adopting the stealth layoff approach like Google and Meta. Snap has publicly announced layoffs of 20% of its employees. This comes after Snap grew its headcount by 65% within the past year and a half. Google, Meta, and Snap are probably the most notable of the companies reducing headcount. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. Last month, Meta Platform CEO Mark Zuckerberg told employees that the company plans to reduce its hiring target for engineers from 10,000 to between 6,000 to 7,000 amid the market downturn. Realistically, there are probably a bunch of people at the company who shouldn't be here, Zuckerberg said. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.